Investors have long treated climate change as a slow-moving risk, something that would unfold gradually over decades. But that assumption is now being challenged. Some of the world's biggest pension funds and asset managers are preparing for a different future, one where climate change accelerates unexpectedly, forcing markets to reprice risk much faster than anyone anticipated. JP Morgan describes these as climate black swan risks. So what exactly are they and why are investors taking them so seriously? Climate tipping points are critical thresholds within Earth's natural systems. Once crossed, the changes can become self-reinforcing and in many cases irreversible. Scientists believe several major Earth systems may be approaching such tipping points, including the Greenland ice sheet, the Amazon rainforest, warm water coral reefs, and the AMOC, a major ocean current that helps regulate Europe's climate. Now, the worrying part is that scientists cannot say exactly when these thresholds might be crossed. But the risk rises with every degree of warming. The world temporarily exceeded 1.5 degrees Celsius above pre-industrial levels during 2024, highlighting how close it is getting to the Paris Agreement threshold. So why are they called black swan risks? In financial markets, a black swan is a rare and difficult to predict event that can have enormous consequences. The concern is that if climate tipping points trigger abrupt environmental changes, markets may not have enough time to adjust gradually. Institutional investors, including Standard Life and Alliance Global Investors, are now studying how climate tipping points could affect their portfolios. Standard Life plans to begin climate tipping point simulations next year and has warned that by 2028, investors who ignore these risks could find themselves outside the mainstream. What could happen to markets? JP Morgan's analysis suggests debt markets could react first. It says investors may not wait for scientific certainty. If governments face rising disaster costs, weaker economic growth, and higher spending, investors could demand higher returns on government bonds, pushing borrowing costs higher. Real estate is another vulnerable area. Properties increasingly exposed to floods, wildfires, coastal erosion, or extreme heat could lose value as insurance becomes more expensive or even unavailable. Insurance companies are already under pressure from rising weather-related claims. As premiums rise or coverage shrinks, the impact could spread to homeowners, businesses, and lenders. Companies with significant exposure to physical climate risks could also come under pressure if investors begin demanding higher returns to compensate for those risks. Now, why should you care? Pension funds, insurers, and sovereign wealth funds, they manage trillions of dollars. Their investment decisions influence where money flows, from government borrowing and infrastructure projects to housing, businesses, and renewable energy. So if they begin pricing climate risks differently, borrowing costs could rise and investment patterns across entire sectors could change. Climate risk, in short, is increasingly becoming financial risk. No investor can predict exactly when a climate tipping point might be crossed. But many now believe that waiting for certainty could prove to be the biggest financial risk of all. Follow Business Standard for more studies.